Dear participants, dear guests, please direct your attention at the monitor. We'll be having our video of the forum now on the screen.
In a changing global economy, price stability is not simply a technical objective. It is the foundation of confidence for households, businesses, investors, and the daily economic decisions of people. For Uzbekistan, monetary policy transformation means building a framework in which decisions are clear, evidence-based, and firmly anchored in the core mandate of price stability. Credibility is strengthened when the mandate is well-defined, institutions are accountable, and policy decisions are explained openly. Since 2017, Uzbekistan has moved into a new phase of macroeconomic modernization. A liberalized foreign exchange market gave the economy greater flexibility to absorb external shocks, reflect fundamentals, and support a more effective monetary policy framework. In 2019, the law on the central bank, adopted in a new edition, established price stability as the primary objective of monetary policy. This marked a shift from a more administrative approach toward a modern framework based on independence, accountability, transparency, and long-term stability. From 2020, the central bank has advanced its inflation targeting framework. The goal is clear: to bring inflation down to 5% and keep it stable over the medium term. Through a framework built around the policy rate, structured decision-making, regular policy cycles, forward-looking analysis and forecasts, monetary policy reports, and open dialogue with the public and financial markets. A modern operational framework has been built around the policy rate, the interest rate corridor, standing facilities, open market operations, and money market instruments. New instruments help the central bank manage liquidity, guide short-term market rates, and strengthen the transmission of policy decisions to the wider economy. The results are measurable. The share of interbank operations in GDP rose from below 5% to more than 42%. By 2026, both actual inflation and inflation expectations had declined markedly compared to mid-2020. Annual inflation fell from around 14% to 5.5%, while inflation expectations almost halved. These results matter because they show deeper money markets, stronger interest rate signals, more effective policy transmission, and gradually improving confidence in the disinflation process. In a modern monetary policy framework, communication is itself part of transmission. By explaining its decisions to society and markets, the central bank reduces uncertainty, anchors expectations, and strengthens credibility. When people understand not only central bank decisions, but also rationale behind them, monetary policy becomes more predictable and more effective. The next stage is anchored in the central bank's Vision 2030, a clear plan with concrete goals. Over the coming years, priorities include deeper financial markets, stronger analytical capacity, faster and more effective transmission, and more firmly anchored expectations. Digital transformation will also shape this path through AI-based fintech solutions. For monetary policy, these reforms matter because they expand the reach of financial services, improve the speed of transmission, and support more inclusive, sustainable growth. Monetary policy today is shaped by global shocks, digitalization, capital flows, geopolitical uncertainty, and changing expectations. That is why monetary policy dialogue matters. Through dialogue with partner central banks, international institutions, and the global research community, Uzbekistan is strengthening its own policy framework and sharing its reform experience with the wider monetary policy community. Monetary Policy Dialogue 2026.
Good morning, distinguished guests, ladies and gentlemen. On behalf of Central Bank of Uzbekistan, it's my pleasure to welcome you to the Monetary Policy Dialogue 2026. The short film you have just watched sets the stage for the conversation ahead, and we are delighted to have you in Tashkent. We will begin our program now. Allow me to take a moment to outline today's agenda. We'll open with remarks from the Governor of the Central Bank of Uzbekistan, who will set out the theme of the forum and welcome our guests. This will be followed by the keynote address from the Athanasios Arpanides, professor of the MIT Sloan School of Management, whose perspective on the conduct of monetary policy is known and respected around the world. Then we will turn to our panel session on monetary policy under global volatility and the wave of the digitalization. It brings together central bank governors, leading academics, and senior international policymakers. It will be moderated by David Baura, panel will be followed by the question, and then we will invite our guests to the group photo. With that, program is your own hand. Please get on. It's now my pleasure and honor to give the floor to the Governor of the Central Bank of Uzbekistan, for his opening remarks.
Excellencies, dear colleagues, guests, welcome to Tashkent. Many of you have traveled a great distance to be here, and we are grateful that you did. It is my privilege to open the monetary policy dialogue and to share the things that will guide our work together. Monetary policy under global volatility and the wave of digitalization. Let me say a word about why we choose it. When we began planning this forum, we asked ourselves here we are dealing with something different in kind. It's not a talk to be measured or a cycle to be ridden out. It is a structural transformation, one that rewiring the foundation of finance and the wider economy while the system continues to run. We are, in a sense, rebuilding the engine of money in the mid-flight. The signs are all around us. Digital payments are expanding at remarkable speed. Tokenized assets are emerging. Central bank digital currencies are moving from concept to experiment and in some economies to reality. And artificial intelligence is beginning to touch the core of our craft, how we supervise, how we research, and how we read the economy in real time. I want to be honest about the character of this change because this is a room that prizes honesty over enthusiasm. Much of the uncertainty digitalization brings is a hopeful kind. The uncertainty of new possibility, of greater efficiency, wider financial access, stronger productivity, new room for growth. But it would be a mistake to call it uncomplicated. The same forces that promise inclusion also raise hard questions of stability, cybersecurity, consumer protection, and ultimately of what a monetary institution is for in a digital age. At the same time, operational and financial resilience is becoming a central policy objective, as digital systems must remain secure, reliable, and trusted even under periods of stress and disruption. Our task is not to celebrate the opportunity or fear the risks, but to be clear-eyed about both at once. That, I think, is the work of this forum. A word then on what we hope this dialogue will be. This is not a venue for scripted positions or careful diplomacy. It is a working dialogue, a space for open, substantive, and at times uncomfortable exchange. I would ask you to challenge one another, test each other's assumptions, bring your hardest question to the table, not your safest ones. A forum like this earns its relevance precisely in the moments where the conversation becomes difficult, because we believe, and I suspect all you do, that good policy is not formed in isolation. It is forged in exactly this kind of exchange. There is a reason we hold this gathering in Tashkent. Uzbekistan sits at the center of Central Asia, the one country that borders every other state in our region. And we have come to regard that not as a matter of geography, but as a matter of responsibility. Shocks in the region do not respect borders, and neither, we believe, should the search for answers. If this platform can become a place where the region's monetary authorities sing together, then this forum will have served its highest purpose. Let me turn to those who gathered here. We are honored to welcome policymakers from across our region and beyond, our valued colleagues from the IMF, the World Bank, and SECO, and the distinguished scholars whose research continues to shape how so many of us think about the problems we face. The quality of the conversation ahead is made possible entirely by the expertise and the diversity of perspective you have brought to the table. To our speakers, our panelists, and every participant, thank you for knowledge you carry on into this room, and for the time and care you have given to being part of it. With this work, it is my pleasure to declare the Monetary Policy Dialogue officially open. Once again, welcome to Tashkent, and thank you for you being with us. Rahmat, hoş gelipsiz. And now it's a great pleasure to handing over to our keynote speaker, Professor Athanasios Arfanidis. Please, floor is yours.
Now you can hear me. Good. What a wonderful introduction. So I worry that the video already reflects some of the messages that I would have liked to leave with you today. It's really a pleasure to participate at the monetary policy dialogue hosted by the Central Bank of Uzbekistan. So my focus this morning is simple. It will be on monetary policy strategy and specifically on how central banks can successfully navigate global volatility. And we've just heard from the governor about the significance of understanding how to do this in the current environment. My message is very simple. Properly implemented, inflation targeting, the framework that the Central Bank of Uzbekistan has adopted in recent years, is a robust monetary framework that is uniquely suited to support growth and prosperity in these difficult times. In a world shaped by geopolitical uncertainty, trade conflict, energy shock, supply chain disruptions, financial crisis, monetary policy needs a clear anchor, and inflation targeting provides that anchor by giving the central bank a transparent goal to maintain price stability. It also provides the institutional framework necessary for the central bank to deliver on that goal. The defining characteristic of inflation targeting are the announcement of a clear numerical inflation target and the operational independence of the central bank to achieve that target. The numerical target gives the public a concrete benchmark for price stability. It makes clear that low and stable inflation is the central bank's primary goal. Operational independence gives the central bank the authority to use its policy instrument without political interference. And these two features work together. The target defines the central bank's primary objective, while the independence gives it the capacity to pursue that objective credibly. Central bank independence is essential for successful monetary policy because defending price stability often requires decisions that are necessary but politically difficult. Short-term political considerations can make it appear appealing to keep interest rates low or to try to boost economic activity, even when doing so is known to lead to higher inflation and instability later on. Such policies may appear beneficial in the short run, but they hinder growth and prosperity over time. Economic outcomes deteriorate. Independence gives the central bank the operational authority to focus on what is best for the economy over the long run. At the same time, independence must be accompanied by accountability, and inflation targeting provides both. It gives the central bank the independence to act, and it gives the public a clear standard by which to judge performance. To be sure, price stability is not the only public policy objective. Ultimately, our societies seek to promote innovation, benefit from technological progress, support sustainable growth, achieve high employment, preserve financial stability, improve social welfare. Price stability is a prerequisite for achieving these broader objectives on a durable basis. When inflation is high and volatile, households cannot plan their spending and savings with confidence. Firms cannot reliably assess investment opportunities. Financial markets demand higher risk premiums. Contracts become more difficult to write, wage negotiations more contentious. Uncertainty about future prices distorts decisions across the economy and creates inefficiencies. Risk premiums rise, discouraging investment in the private sector, and for the public sector, worsening public finances by raising the cost of refinancing government debt. In such an environment, growth and employment suffer. By maintaining price stability, the central bank creates the monetary foundation on which the economy can achieve its potential, supporting growth and prosperity. Another important element of inflation targeting is transparent communication of policy and inflation projections. This serves several purposes. It explains the systematic nature of policy, including how the policy interest rates can be expected to respond to economic shocks. This transparency makes the central bank more accountable, reinforcing credibility and protecting its independence, especially when monetary conditions must be tightened in response to adverse shocks or kept tight when shocks keep coming that are not the most favorable for anybody. Because monetary policy affects the economy with a lag, a forward-looking orientation is essential. Central banks must monitor inflation expectations, not only current inflation. Communicating the central bank's analysis and inflation projections helps households and businesses plan better. When done well, it also contributes to the anchoring of inflation expectations. Now, anchoring inflation expectations in line with the central bank's price stability objective is of paramount importance for the effectiveness of monetary policy. Inflation is not only shaped by current conditions, it is also shaped by beliefs about the future, including beliefs about whether monetary policy will guide inflation back to the central bank's goal. An adverse shock can raise costs and inflation today. If inflation expectations remain well anchored, the shock can be managed with good policy. But the same shock can be far more costly if households and businesses expect inflation to persist. Workers will demand higher wages. Firms expecting higher costs will raise prices preemptively. Inflation will begin to feed on itself. A temporary adverse shock can become a costly and persistent problem because expectations adjust in the wrong direction. Inflation targeting reduces this risk by making the central bank's objective clear and by communicating that policy will respond in a systematic fashion when inflation threatens to move away from target. Drawn by the relative success of inflation targeting, an increasing number of central banks have adopted it around the world. And this includes the Central Bank of Uzbekistan that in recent years belongs to this group. In line with good practice, the central bank has become more transparent in its communication and provides clear analysis of its policy and inflation projections in regularly published monetary policy reports. In the slide, I just reproduced the inflation forecasts from the monetary policy report for the first quarter of this year. As you can see, and consistent with the experience of many countries during the post-pandemic recovery, inflation has been running above the target. In line with the inflation targeting approach, monetary policy has been calibrated to bring inflation down toward the target over coming quarters. And you can see the progress in the last few years and the projected progress towards the target. Maintaining this monetary stance and maintaining the focus on the target is critical for the long-run success of this framework. Inflation targeting is effective because it is not simply a vague promise to defend price stability together with many other goals. It is an institutional framework that establishes price stability as the central bank's primary responsibility and gives the central bank the authority and accountability needed to achieve it. However, modeling this policy approach has not been straightforward. And yes, I'm a modeler, I'm an economist, and I arrived here in Tashkent from MIT, so I need to talk for a couple of minutes about modeling things for you, but I promise I will not show you any equations whatsoever today. One strand of the literature identifies inflation targeting with the solution to a central bank optimization problem in a linear rational expectations model of the economy, complicated mathematical speak. In that setting, it has been argued that inflation targeting can be improved by introducing flexibility. And this is not a technical issue. This is what I want to focus on. The argument is that flexibility is needed to pursue other goals, such as greater stability of real economic activity. And in the models, it is argued that this can be achieved without compromising price stability. To describe the benefits of flexibility, these models typically impose a quadratic loss function with multiple objectives and so forth. Additional simplifying assumptions are then made so that the solution can be fit very nicely with mathematical techniques. Those assumptions typically include perfect knowledge of the underlying structure of the economy by the central bank, households, businesses, and complete credibility regarding the central bank's objectives. And under the assumption of perfect knowledge, such models typically imply that long-run horizon expectations are well anchored. In this setting, central bank is presented with a hypothetical menu that I show here in this chart. Inflation targeting with its singular focus on the ultimate objective of price stability is presented as a choice that favors very low volatility of inflation. You can see the green dot over there, and higher volatility in output. Flexible inflation targeting, is argued, is represented by another point that reduces the volatility of output in the models. And the volatility trade-off presented in such models can appear to suggest that flexible inflation targeting is generally superior to inflation targeting. And this reasoning has influenced policy. Looking around the world over the past decades, I see that some central banks that originally adopted inflation targeting subsequently shifted toward flexible inflation targeting. In this setting, flexibility is presented as a virtue, one that appears to improve the stability of the economy. However, this analysis can be highly misleading and can lead to incorrect conclusions about monetary policy. The main problem is that these models may suggest the feasibility of outcomes, such as the ones presented here, that are too ambitious and not feasible in practice. Under the imposed assumption of perfect knowledge, inflation expectations are always well anchored. Economic shocks have more benign consequences, and the fine-tuning of policy appears able to stabilize the real side of the economy more easily than what is feasible in practice. The main problem is that using such models for policy analysis may suggest the feasibility of over-ambitious outcomes that are just not feasible under the imposed assumptions. Flexible inflation targeting appears appealing mainly because inflation expectations are assumed to remain well anchored no matter what, which is not true in case. So how do we deal with this thing? In a model, under the assumption of perfect knowledge, it appears to work that you can actually have a gradualist policy that delivers low volatility of output at a fairly small cost in terms of inflation. However, this downplays the cost that added flexibility imposes through the disanchoring of inflation expectations in practice. That cost is important because the economy is characterized by imperfect knowledge in practice. We can just not assume that policymakers, businesses, and households know the true structure of the economy in real time. Policymakers cannot precisely observe concepts such as the natural rate of unemployment, the neutral interest rate, the output gap, or the size and persistence of every shock. The public also operates with imperfect knowledge. Households and firms and investors do not automatically know what the central bank will do and how shocks evolve in the economy. Inflation targeting solves this problem by giving the public a simple focal point. The central bank is committed to the inflation target. In short, flexible inflation targeting is a far less robust monetary policy framework. It can lead to worse outcomes than inflation targeting. And to illustrate this risk of a policy strategy that downplays the danger of disanchored inflation expectations, we need to modify our models to acknowledge economic agents' imperfect understanding of the macroeconomic environment. And I'll show you an illustration of that in just a single slide. This is based on joint work with John C. Williams that examined the policy implications of replacing the assumption of perfect knowledge in a simple model with imperfect knowledge. Imperfect knowledge is captured with the introduction of learning. People don't know everything. We actually observe what is happening in the economy. We try to learn from that. We form expectations from that. Once imperfect knowledge is introduced in this model, the hypothetical volatility trade-off that appears under perfect knowledge is distorted. Flexibility on the part of the central bank can lead to a weakening of the inflation anchor. Inflation expectations can drift. The result is greater volatility of both inflation and output. There's a simple lesson in this. Flexible inflation targeting may appear attractive under the unrealistic assumption of perfect knowledge, but under imperfect knowledge, inflation targeting is the more robust and superior monetary policy strategy. Its value comes from its clarity, its focus, its ability to anchor inflation expectations more effectively in practice. This brings me to the conclusion. Inflation targeting is well suited for navigating global volatility. The transparency and accountability of the framework reinforce credibility, protect central bank independence, which is necessary for the success of the framework. The focus on the inflation goal anchors inflation expectations even in the challenging environment that we have been facing in the past several years. Well-anchored inflation expectations are critical. They improve the effectiveness of monetary policy in counteracting business cycle fluctuations. They also importantly reduce risk premiums, which lowers the cost of investment and lowers the cost of public finance. Properly implemented, inflation targeting is a simple and robust monetary policy framework. It gives monetary policy a clear anchor in a volatile world. It protects the value of money. It supports confidence, investment, and sustainable growth. But I'm just repeating what you've seen in the short video we had before. to end by pointing out again, inflation targeting is uniquely suited to support growth and prosperity in challenging times. Thank you.
Thank you very much, Professor. Now we will turn to our panel session. Panel will be moderated by Mr. David Vavra, Managing Partner of OG Research.
Thank you, Mr. Deputy Chairman. Can everyone hear me? Even if I let's rearrange slightly. Dear esteemed guests, colleagues, friends, ladies and gentlemen, welcome to the panel session of the Monetary Policy Dialogue Forum. The title of this panel session brings together two forces that are seem desperate. It's global volatility and digital transformation. They may sound like separate agendas that have nothing to do with each other. But in fact, what they have in common, apart from some intricate feedback loops, is that they both challenge in real time the very essence of what we understand by modern monetary policy and central banking, and that is stability. What we heard in the introductory video was all about stability, price stability, currency stability, financial stability. And so these two forces threaten to upend that very paradigm. And they force us to ask some very uncomfortable questions. Are we ready to take good decisions, most policy decisions, under these two forces? Are our frameworks ready to help us make those good decisions, considering that these frameworks were put in place long before these challenges became acute. Our frame was ready, echoing words of Athanasius, should we rethink the frameworks or should we double down? As commitment to inflation target, the steadfast commitment to inflation target, still the anchor that we should follow? Should we be more or less flexible in our response to shocks, to supply shocks in particular? Are we even equipped technically to understand this era of, not new era of volatility, I would say era of new volatility? And going forward, digital transformation, where is it going to lead us? Is it going to be central bank digital currencies? Is it going to be tokenized assets, deposits? Is it going to be stable coins? We don't know. But more importantly, is this rapid technological advance a threat, a shock amplifier, or can we harness it for the benefit of monetary policy? Can we harness it to understand better in the nature of shocks in real time, and can we harness it to strengthen monetary transmission rather than to loosen it? So these are some uncomfortable questions, but we are fortunate that we have a panel today that can look at them from various angles. And I'm very privileged to be joined by a group of experienced policymakers as well as distinguished scholars. I'll start with Mr. Bali, Deputy Managing Director of the IMF, who supervises the fund's work over, say, 90 countries, and represents an institution that coordinates a global response to these and other challenges, of course, and also tries to set the standards, best practices on how to analyze and think about these issues at large. Governor Martin Schlegel leads Swiss National Bank, an institution that managed to remarkably keep inflation in check during the post-COVID inflation surge. I just named one thing, but I think it will be a recurrent theme in the panel discussion. Governor Ishmetov, as we heard already, embarked on a very ambitious journey of building inflation targeting, while these two challenges, global volatility and digital transformation, were taking place. I think that's a unique experience in the world, and we'll be keen to hear more of your experience. Dr. Hugh Bill, Chief Economist of Bank of England, member of the Monetary Policy Committee. As Chief Economist, Hugh is responsible for all the analytical work and support to monetary policy decisions at the Bank of England, and also all other research, I guess, that the bank does. Professor Michael McMahon has done much work and research on how central banks communicate, what they communicate, and how these messages actually reach the audience, and whether the right messages reach the audience. So I think it's going to be very relevant for a discussion of credibility. Professor Toshitaka Sekine of Hitotsubashi University. Toshi has spent most of his career at the Bank of Japan, including as chief economist, but he also written extensively on digital transformation, he studied patterns of changing behavior in payment systems when people transferred from cash to cashless transactions. So that will be a very important and interesting to hear your insights. And finally, Cedric T. Of the Geneva Institute of International and Development Studies. Professor T is responsible and oversees Swiss government's program of technical assistance to central banks. But previously, he had also spent a number of years on the council of the Swiss National Bank and has written extensively on shock transmission through various channels, trade, capital flows, and currency markets, how shocks propagate to economies, especially in the emerging market context. So I'm very happy that I have this selection of experts and policymakers with me today, and I think we can begin. So in terms of organization, I will now ask the panelists to give introductory remarks to these topics in the same order that I have now introduced, and then we'll follow with moderated discussions and Q&A. Mr. Deputy Managing Director, your turn.
Thank you, David. Let me briefly touch on two aspects of today's discussion. One is on the global outlook, because monetary policy has to be made in the context of the global economic outlook. So let me use 3 words to summarize our take of the global economic outlook. One, the first keyword is uncertainty. There is heightened uncertainty. We have seen that in the last 10 years, that uncertainty is rising. There are shocks after shocks, supply side shocks, demand side shocks, that making monetary policy more challenging. The second keyword is resilience. Even though we have seen so many shocks in the last 10 years, the global economy has held up quite well in many aspects. There is a lot of resilience that we did not have probably 20 or 30 years ago. We see monetary policy become more credible. We see fiscal policy become stronger in many countries. Of course, there are also hiccups, right? We see the latest inflation episode in 2022. So there were hiccups. But overall, we have avoided the kind of great depression and great recession that we have seen, in 2008 or even 100 years ago. So resilience. And the last word I would say is unevenness or disparities. We see if we look across countries are impacted unevenly by the shocks. Some countries are doing okay, notably U.S. And also the latest conflict in the Middle East. We see some of the oil exporters doing okay, but we see a lot of challenges among emerging markets and developing countries, especially energy importers. In the latest round, they are facing a lot of challenges. And we are particularly worried about the very high, the energy price, the fertilizer price, their impact potentially on some of our low-income country members. So given this background, what are considerations of policy? Let me highlight several. The first one is central bank independence. We have seen attacks on central bank independence in the last several years, both in the advanced economies and also in developing countries. And we all know that central bank independence is key to the credibility of monetary policy. Without an independent and strong central bank, the credibility of monetary policy will be severely harmed. The second consideration, given this environment, is that scenario analysis, contingency planning are very important for central banks. Given the high uncertainty, one baseline may not be enough. Central banks may need to think about more than one scenario. Think about their reaction function under different scenario. That's the second consideration. The third one is in terms of communication, what to communicate to the market. And given the high level of uncertainty, it may make sense also to communicate to the market more than one scenario. Of course, there is a balancing consideration, which is that it may be confusing if central bank communicate more than one scenario. So there is a balancing act, and we see different central banks experimenting with different communication strategy. And I think the jury is still out in terms of what is the most effective communication in this kind of highly uncertain environment. And finally, for emerging market and developing countries, in addition to monetary policy, traditional monetary policy, there are also other tools that can be utilized in face of highly